Hello guys, welcome to a brand new masterclass, and today's masterclass is going to be on market makers. This is one that I put a lot of work in. I hope you guys do enjoy this one. This is probably one of my favorite one out of probably the prior one that I've made thus far, and the future one probably that I'll also make. So far, I think we had a pretty good trading month of for March. A lot of lesson learned. I'll share a lot in my future documentary. I have a current docu-series that I'm currently putting together for some of the things that I'm doing trading wise with some of those funded account. Enough of the distractions. Let's go ahead and dive in. This masterclass is going to be extremely concise and direct to the point. No fluff. So I'm going to try my best to give you also a lot of brand new information of different ways of implementing things that you probably have already seen from other market maker videos. So without any further delay, let's go ahead and get started. First, I'm going to first tackle this market logic, why price does what it does, okay? I believe that there are four reasons why market moves, right? Either move because we're either engineering liquidity, we're either hunting liquidity, rebalancing inefficiency, or rebalancing to equilibrium or OTE level. So first reason, engineering liquidity. One of the things that I learned when coming into ICT trading is that, or ICT concept, I should say, is that price does not just move randomly, right? There's a reason why price move. And one of the primary reason is because it's engineering liquidity. Now, this concept was something that it took me some time to really understand because I used to think that smart money or institution could see people stop loss and could stop us out and so on and so forth. But in reality, they cannot see your stop loss. They cannot see your level of all the liquidity level for retail trader. All price does continuously over and over is utilize people's psychology, right? People's fear or greed way of thinking to build algorithm and build liquidity level, right? Build algorithm, when I say build algorithm, is build a certain type of price movement that induce people to leave stop loss at certain level, leave their order at certain level, place their order at some point, right? And that's actually what create liquidity. It's a collective way of thinking from a retail standpoint and not even to a certain degree from institutional standpoint as well, or the institutional perspective, I should say. So when you think about engineering liquidity, it's not necessarily market maker or some godlike figure who is taking people's liquidity or purposely making people put their order at some level. No, it's moving the market in a way where people are going to naturally place the order at some level. And one of the most popular model for price for those liquidity provider, I would say I will mainly refer to them as liquidity provider, to employ to allow people to build liquidity at a certain level is a market maker model framework. Okay. By the way, also one of the most popular liquidity providers actually called Citadel Security. They're one of the biggest liquidity providers. So I want you to think about any sort of broker, whether that's future, forex, or stock, you name it. They need liquidity in order for market to operate, right? For transaction between sellers and buyers to operate, we need some sort of liquidity. That's why even when you see where nobody's supposed to naturally trade, you still see the market move. You still see the market push and give volume. It's not because people are trading 24/7 at all given time. No. When you see the market pausing and we don't even have any sort of liquidity in there, it is still moving because we have liquidity provider. And then one of the framework, the most popular framework that they utilize to move the market is the market maker model. So if you can really understand the ins and outs of this model and how to read and anticipate, right, when it reverse and as it distributes as well, that will give you such an edge in the market. One of the other reasons is hunting liquidity. That's the second reason here. Hunting liquidity happens almost every single moment of the day, right? A lot of the time, what you're going to see is that prior days or prior session, we're going to create liquidity. We're going to create a certain type of resistance of liquidity that price typically will run later on, right? You need to start training your eyes to identify that type of liquidity that's being created and how it also is being created and learning to anticipate. I'm going to touch upon that in the next few slides in this specific masterclass. Next up is rebalancing inefficiency. As price move, we're going to create a lot. We're going to create a lot of inefficiency a lot of the time when price moves too rapidly from one point to another, right? So it is very, very important to understand why price rebalance those inefficiency. If we move too fast from A to B, guess what? We're going to want to pause and come back to A, rebalance, or come halfway between A and B and rebalance before continuously moving forward. So it's very, very important to understand that, okay? You need to understand that we need to rebalance if we move too aggressively. And lastly, rebalancing to equilibrium and OT level. This is more attached to market structure. So let's say, for example, we have higher highs, higher lows, right? We have a higher high, higher lows. We create higher highs and higher lows. When we leave this higher low right here to create a higher high, guess what? We have a range that we're creating here. At some point, price is going to come back to rebalance to equilibrium, which is a 50% of this range, or it can come back to rebalance to OTE level, which is somewhere around 65, 60% or 75% of this range, and maybe seek a specific level, BD fair value gap, you name it, regardless, before continuously moving forward. But those are typically going to be the 4 reasons why the market move. Always going to be one of those reasons. So I want you to be aware of that as we move forward into this presentation, because it's going to be a very key principle you're going to need to keep track of consistently. And at some point, it's going to become second part of your nature. Yeah. I'm not sure if it's the right to say second part of your nature or part of your nature, essentially. But with that said, guys, I want us to move forward to the next slide. So here I want to go over the anatomy of a market maker model. Okay. Usually, very, very high probability market maker model I like to identify is typically an origin of consolidation that has relative equal highs and relative equal lows. So essentially a really nice looking accumulation zone here where we're essentially consolidating and we're not giving market any sort of direction yet. When price break away from this origin of consolidation or from this accumulation or consolidation, regardless of how you name it, we're typically going to be accumulating in one direction, one either upward or downward, right, to the sell side or to the buy side. In this example here, we are in a market maker buy model, obviously. So we're going to be accumulating to the sell side. And as we accumulate to the sell side, you're going to see accumulation typically form next. So you're going to see another smaller phase of consolidation here. Ideally, what I look for is for that to have some type of relative equal high. It does not have to be. It could be literally just be a one swing and price continuously move down. That's completely fine. And then at some point, that's where you're going to continuously see reaccumulation. It does not have to have reaccumulation. You can simply have an accumulation and boom, we go to the next phase. And then you have accumulation right here, right? Next up, after this reaccumulation, typically you will have what I call manipulation to a specific high time frame PD array, right? The manipulation to the specific high time frame PD array will involve a target. That target will be based on the time frame that you are looking at this market maker framework, essentially. So I'm going to talk about later on how to identify, how to anticipate the right manipulation target. There are 2 key principles or 2 key factors to take in consideration when trying to anticipate that. But I want you to remember that this is the manipulation phase. Manipulation phase, if you master how to read manipulation phase, that's probably going to be one of the biggest skill set in understanding how to catch the next phase, which is the smart money reversal or first stage distribution right here. So the smart money reversal will happen here to indicate that we are reversing and now we're trying to seek back to the origin of consolidation. And one of the other characteristics of a market maker buy model or sell model for that matter is that we will leave behind low resistance liquidity. As you guys can see right here, we have continuous fail swing that are being created and can draw a line that cross all these, right? Once price start breaking past that, we have easy level of liquidity that price can run through, right? When you see this happen, when you have multiple accumulation or consolidation zone that are being formed along this curve, this will be the sell curve right here. This gives us confidence that now we have low resistance. We have liquidity that we can run through with ease as we cut through these, okay? That's something I want you guys to keep in mind. It's very, very important to remember this. Very, very low resistance liquidity that we can run back to. So another part of the anatomy for me, right? This is uniquely for me. But other people out there, you can find different definition of what they look for in terms of SMT. For me, I would like to see SMT at the lows here, since we are in a market maker buy model. So for the reversal, you want to see a bullish SMT with either ES or YM. So let's say, for example, we're grabbing sell side liquidity here, right? Let's say we're grabbing a sell side liquidity on the 1 hour sell side. You want, once NQ grab this sell side on the 1 hour, you want to see ES and YM fail to grab their respective 1 hour sell side on the chart, on their chart, respectively. Either one or the other. It doesn't have to be both. It just has to be one of them. So you need to continuously check across all three indices to always ensure that, do we have SMTs of my reversal, right? Because if you have SMT of your reversal, you have a higher time frame PDA rate that you have identified, obviously, for that. And then you're getting confirmation of the reversal inside of here. Those are your signature in price for price to essentially starting to reverse and going into a smart money reversal here and essentially distributing on the first stage. Once this distribution on the first stage is accomplished, usually around standard deviation 1.5, and in some case 2, but usually it's going to be 1.5, you're going to see the second stage distribution form at this level. And then typically 2.5 or sometime standard deviation 4 will line up with the origin of consolidation for price to complete this model, usually. So I know it was a lot, but these are the anatomy of a market maker model. Okay, I'm going to go over an illustration later on in the presentation. So first, I'm going to tackle some of the components that I discussed just now. So we're going to go ahead and go into the next chart. I hope that made sense and that was insightful. So next up, we have right here, low resistance liquidity versus high resistance liquidity. So in the last slide, like I discussed, if you see price form multiple fail swing like this or many consolidation phases that leave that left behind and almost are in consecutive motion like this, these are typically what you would consider your low resistance liquidity run. Even this one right here, if there's one here, you can add it to this one. So when price run through this is what you will call low resistance liquidity run. And then price will typically have an easy time running to this, right? I know I marked up or pointed this as the low resistance liquidity run. This is what happened when we have low resistance liquidity. And this is not a low resistance liquidity. And this is your low resistance liquidity run. I don't know why I pointed this in this direction, but I hope this makes sense. Low resistance liquidity run is essentially fail swing, boom, boom, right here, boom, 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 and boom. It's a collection of low resistance liquidity run that makes it easy for price to typically run through, right? Usually it's not going to be like this. It can be like this a lot of the time, but most of the time it's going to be something like this, stops here, pause here, and then boom, go here, and then boom, and complete it. It's going to be rapid. It's not like if you really count down the time price took to stop price from here to here, it could have been like an entire day, right? This could have taken out a whole day to form, but this could have taken 2 hours to complete. That's what you want to see in low resistance liquidity run scenario. That's what you want to see. Now, in a high resistance liquidity run, price is going to leave a lot of inefficiency behind, right? There's going to be no pause. It's going to be the complete opposite of here. So you see how I told you that here, we took 2 hours, maybe let's say to complete this, and this maybe took us 1 day. Now it's going to be the reverse here. Now this could have taken us, who knows, 3 hours to make, right? But the build up here could take us half a day, right? To completely run this high resistance. So that means that if you are holding a trade, if you catch a trade here, and there's a trade that you catch here, and there's a trade that you could catch here, which one would you pick? Would you want to trade this liquidity, or would you want to trade this liquidity? Obviously, this liquidity, right? Because we have low resistance liquidity run. This is more likely to run much more easily compared to this one. Now, this is not going to be set in stone where everything going to happen in this way. You obviously have to trade and treat everything with, discretion. right? You have to identify a scenario where everything lines up and you're able to utilize this low resistance liquidity. In this instance here, in this presentation that we're doing today, is the framework of a market maker model, right? If you have low resistance liquidity run attached to your market maker model, it makes everything easy for you to get into your trade because you have liquidity that can be run against, right? So your trade can have an easy time seeking its target. I really hope that makes sense. So after this, you guys should have an idea of what low resistance liquidity run is and what is high resistance liquidity run. SMT, smart money divergence breakdown. So I will try my best to simplify this. I think I've seen a lot of people give different explanation on this, but this explanation probably going to be one of the simplest that you guys going to encounter. So let's say, for example, you are on a 1 hour time frame, right? We're looking at a 1 hour time frame, and then SMT can be done on any time frame if you want to identify. It could be done on 15 minutes, 1 minute, but for this instance, I'm going to use the 1 hour. So that means that every single candle, right, represent 1 hour. So in this example here, SMT, all it means is that if you're trading NQ, and then let's say this is the time that you're trading. You're trying to trade the 10 a.m., let's say 10 a.m. silver bullet, or you're trying to find an entry around 10 a.m. If you want your trade to have an SMT divergence attached to it, what you want to see is that, okay, you want to identify a low that 10 a.m. candle recently took, whether that's 8 a.m., it could be 9 a.m., it could be whatever, right? You want to see that low and check the other indices and see if they have failed to take that same low since NQ has already taken it. And it will be the reverse, right? If NQ did not take that low, you want to see if the other indices have taken out that low, or and vice versa. So in this instance here, NQ has taken out the 8 a.m. low right here. So as you guys can see, I marked up the 8 a.m. low, right? When I say 8 a.m. low, this candle represents the 8 a.m. 1 hour candle, right? All these are 1 hour candles. If you go on your chart, if you hover your mouse over this candle, it will tell you exactly the time on the bottom of the chart, right? Because the bottom of the chart represents time, and then the side of the chart represent price. Right here we have price, right here we have time. So if you hover your mouse over a candle, it would tell you on the bottom right here what time is it, and it should say 8 a.m., right? On the bottom of my chart right here. So if on the bottom of my chart says 8 a.m. here on ES, right? I'm looking at ES, and then I already know on NQ, this also shows 8 a.m. right here, right? I'm checking and I'm saying, okay, NQ has taken out that low at 8 a.m. Let me check on ES. Okay, AM, when I hover over the mouse on top of that 1 hour candle, 8 a.m. low candle, guess what? It failed to take it. And I check on YM, it also did the same thing. We failed to take it at 8 a.m. We failed to take out at 8 a.m. low. Guess what? Now we have SMTs at the lows. I have used this technique to easily identify SMT's formation in play. And that has been one of the easiest way for me to probably explain this to other people as well. So if this makes sense for you, I hope this helps. So you can add SMT as an additional confluence or signature in price check that you typically would do to give your trade typically a stronger chance of winning. I strongly believe you ought to add that to your arsenal. It just makes your trade much, much stronger in general. So with that said, you guys have a greater understanding now of what an SMT divergence mean across the indices. And typically you only want to check this with indices, right? So NQ, ES, and YM. So if you're trading on NQ, you want to check to see if ES or YM has SMT divergence at one of the structural lows, right? If one get taken out, you want to see the other one fail to get taken out, and vice versa. So that's SMT divergence for you guys. Smart money reversal. This is going to be very, very important to identify and then anticipate, right? So talk about a smart money reversal and manipulation phase, right? How to anticipate the manipulation phase, reversal, or the smart money reversal, essentially, or the first stage distribution. So many names out there. The two things that I really want you to focus on is going to be time alignment and standard deviation levels. It's very, very key to understand how to utilize these other two confluences or factor or key things that are utilized to be able to determine where and potentially where the manipulation phase may end. All right. And when we can potentially start seeing small money reversal occur. So in terms of manipulation target, you can only find your manipulation target if you have time alignment. If you're trading on the 1 minute time frame, you want to see, let me remove this. You want to see, identify a 15-minute POI, right? That get taken out or price reject off of or react off of. So a 15-minute fair value gap, a 15-minute sell side or 15-minute buy side if you're looking for it to taken out and reverse to the sell side. You want to identify a 15-minute POI that get taken out or reject off of for you to be able to consider that as your SMR or your small money reversal or potential first stage distribution. If you are trading on a 5 minute, if you're looking for an entry on a 5 minute to identify a market maker on a 5 minutes, you want to identify a 1 hour PD array that you want to reject off of, tap into, or essentially get taken out, right? 1 hour buy side, sell side, or fair value gap. And same thing for the 15-minute time frame. If you identify a market maker on a 15-minute time frame, you want to identify a 4 hour POI, sell side, buy side, on a 4 hour or fair value gap that get taken out or tapped into, and essentially start reversing. Other people like to utilize order block. You can, however, for me, for my POI for reversal, I typically like to use either a fair value gap, sell side, or buy side, right? Based on those time frame. Typically, that's going to be the best. The other POI that you can also utilize are old lows, right? But typically they're automatically going to be one of these, right? So if you identify a previous day low and there's a swing attached to that, it's not going to be 100% of the time, but I think 70% of the time, to probably like 75 to 85% of the time, they're going to have some type of like, they're going to be aligning with the being a higher time frame POI, like a higher time frame 15-minute or 1 hour's sell side or buy side, essentially. So that's why I didn't include old lows or old highs essentially here, or like old level of liquidity essentially. But that's it for time alignment. It's very straightforward. Next up, standard deviation levels. Most of the reversal that you guys will see, if you can identify your leg of manipulation, right? So on the reversal phase, right? Remember I talked about when we start reversing, the reversal will typically have what you call a manipulation leg. And in the live bar replay example that I'm going to go over when I dive into inside of the chart, I'm going to talk about that. The manipulation, if you grab the lows and the highs of the manipulation leg, it typically will tell you where the key reversal level going to be situated at. So when you grab the standard deviation using the manipulation leg, the first reversal typically can happen off the standard deviation 1.5, where you get a pullback inside of the range of that extension of that displacement range or that range that's created, right? So once you get that reversal, you can get another breaker or another market structure with displacement or an inversion of fair value gap that get respected, or PDA that get created to indicate the next stage of distribution, the second stage that can take you all the way to 2.5 standard deviation or all the way to 4 standard deviation. In some cases, you can go all the way to 5 standard deviation. So the key level I want you to pay attention here is this one, right? Because here is sometime where you can anticipate the reversal, right? A reversal to happen. But the best levels are going to be 2.5, 4, or 5. That's why I have them in stronger color here on the bottom. So these levels right here are the one that I look for where we can see potential small money reversal. Ideally 4, but it can also happen off 2.5. So these two are going to be the predominant one, but you can also check 5. But 2 and 4, 2.5 and 4 are going to be your sweet spot. Okay. So now that you guys have everything that you need, so 2.5, remember 1.5, you can get a pullback for continuation to 2.5 and 4 right here. And then most SMR will happen around this true zone right here. This is SMR territory. 2.5 standard deviation and 4 standard deviation. Make sense? It may not make sense. I'm going to show you guys an illustration. If it does not make sense yet, it should make sense now after this illustration here. So let's say, for example, you are trading and then you're trying to anticipate a market maker buy model forming, for example, here, right? So you have your origin of consolidation here. For time alignment, we're on a 1 minute time frame. So we are looking at a 15-minute either sell side or 15-minute fair value gap, essentially a BC, to essentially trade into for us to determine the reversal. We're also looking for SMT to start forming as well once we start hitting that reversal zone, right? So looking at this, this is our origin of consolidation. The manipulation leg for this right here will be where? This right here, right? This push here, sweep the liquidity above this, and then initiate this reversal right here that we get. So right here is a manipulation leg. So when I grab the standard deviation tool from 1 to 0 here, and then the negative level, extend to 2.5 to this right here. So that means that the 2.5 is where I can anticipate a potential reversal and a shift and potentially complete this market maker buy model that could be potentially forming. All I'm just showing you here is how to anticipate where the small money reversal may be forming or the first stage of distribution, which will be somewhere here, could be forming, right? And then if this forms, we can essentially push to 1.5, get a pullback, right, somewhere in here, and then extend to either 2.5 again right here, and then maybe pull back again, and then extend to 4, and then complete this market maker bar model, right? I know my drawing is not the best, but I hope this makes sense. However, I'm anticipating none of this has happened yet, right? That's why I have it in dots, right? In dashes. None of this has happened yet, right? All of this is in dashes, but I'm anticipating with the information the market has given me thus far. So right here will be the manipulation leg that I will have here, right? This will be my manipulation. Like if we reverse off the zone here, we form SMTs. We're also reversing off here. So how many confluences am I having here? So many. We have our 15-minute POI, right? Because we're in 1 minute. So our time alignment is in check. We have the 2.5 standard deviation from this origin of consolidation here that's lining up and giving us additional confidence in terms of standard deviation levels. We have SMTs, right? We either ES or YM that formed here. All we are left here for to see if we form is a rejection here that gives us some type of strong small money reversal. Everything else will have lined up. The other thing that I didn't include is time, right? So if this is lining up within one of our window of delivery, this will be perfect, beautiful. So I hope this starting to make sense. I hope this starting to make sense, right? So just adding confluence, stacking confluence, just being so confident and knowing that this is not random. Things are not happening randomly. This is just lining up perfectly. So with that said, let's go over the next step. Next up, we're going to go into bar replay examples. So we're going to dive inside of the chart. I'm going to show you guys a live example replay of that. And we're going to touch on time a little bit more as well. But let's go ahead and dive in the chart. Let's go. We're back inside of the chart right here. And as you guys can see, we have NQ chart open right here. This is actually a trade data that I've taken. This is actually a trade example that I've taken. I'm going to go over some type of a real example that I have used here. So here, this is on Friday the 22nd. We're not too far from the day when I'm recording this training video. On this day, right around 8:35, 8:36, we essentially had a smart money reversal of this zone right here. And some of the confluence that I had lined up for me is that the previous day low, right? I have an indicator here that tells me what are the previous day low. The previous day low, which was all the way right here, of this zone right here. You see this green dot? This indicator tells me automatically what are the previous day low and then the previous day highs and stuff like that. Also previous week highs as well. So on NQ, we had taken out the previous day low, which was this level here. We also had taken out a 50 minutes sell side liquidity. And we're also tapping inside a 15-minute fair value gap. Okay. Here on the other indice right here that you guys can see right here, this is YM. We failed to do so. See how the previous day low is all the way down here by the time when we took this, right? So we never took the previous day low on YM, but on NQ we did. As you guys can see, I use this dash to outline that. Also, the specific candle that I use to check, see right here, the A15 candle right here is the one that took that out, right? The very first one. This one took it out again, but the fact that you're all the way up here, it's very, very low probability. If you start reversing here, I'll completely feel confident because there's a lot of breathing room here before this get taken out. I mean, what are the odds that price going to just dunk and then give us a reversal here and then not have a valid SMT? This is still going to be valid by the time this reverse. So I felt very, very confident that this SMT was going to hold, right? We had taken out liquidity or higher time frame POI because now we're on a 1 minute, right? Also, I have identified my origin of consolidation. So now that we have got that out of the way, I'm going to make this a one chart instead of two chart colliding. We have an origin of consolidation all the way up here. So I'm going to mark this up here. Origin of consolidation right here. We had what looked like an origin of consolidation. We had an accumulation right there as well. Accumulation right here, right below these levels. And then we essentially manipulate. This whole phase right here is our manipulation until we take out these, right? This is our manipulation right here. So manipulation phase. All this is a manipulation phase. We tap into this and then we begin smart money reversal, right? Of this because we have SMTs at the lows. We have grab liquidity and we tapping inside of a 15-minute fair value gap as well. I can go on a 15-minute and show you guys as well what that looks like. So on a 15-minute time frame, as you guys can see, right, we're taking out liquidity and then we're tapping inside of this massive 15-minute fair value gap. Another thing that I use as well is 50% level. If I see strong reaction of a 50% level of fair value gap, it typically just give me additional confluence because look at this, the 50%, right, which is the consequential encroachment of this 15-minute fair value gap. See how we're holding with bodies at the 50% level. Price does not seek to breach below that. That's typically a strong indication that this level wants to hold, right? Because on the 15-minute, as you can see, we failed to go below with bodies on that 15-minute fair value gap. So I typically love to see things like that because it gives me a lot of confidence that what I'm looking at is the right thing. What I'm looking to trade is the right direction. So this is our 50% level, which is holding for this 15-minute fair value gap. Where was our PD area here? Here we had a breaker that was formed, right? So the lowest point right here was this, right? So we push up here and then we sold off. But before we sold off, the last swing that was created was right here. Let me highlight that. This was the last swing high that we created prior to continuously dropping. So I want you guys to highlight that. So this right here and this right here is a manipulation. Like that's why if you guys see, this is what I highlighted as my manipulation leg, and this is our breaker right here. I can make it a little bit more visible. This is our breaker right here. What color can I make this so it's more visible? There we go. This right here is our breaker. All right, so when price broke above this level, that's actually one of the trades that took right around the 850 macros, right? 850 macros because we had liquidity and then everything lined up. Now, what will be my first target? Standard deviation, 1.5. So this was my actual first trade, literally my actual first trade that I took. I think we broke above here and I got in somewhere here. And my standard deviation 1.5 target was right there. Standard deviation 1.5. We tagged that. And this was my first stage distribution right here, guys. Okay. And then I got in because this was lining up perfectly around the 850 macros. 850 macros landed perfectly for this entry right here, right? So that was the first entry that delivered relatively well. We had some red folder news on that day. That didn't really bother me because any sort of major announcement had already came out earlier that week. So I felt very confident holding this to my standard deviation 1.5. So this was our first stage distribution here, right? That quite confirmed that this was a reversal. The next entry was the next window of delivery, which was 950 macro, my next key one typically that I'll look at trading 950 macro right here. And then right around that macro, we also had the 10 a.m. silver bullet, right? But the entry actually was the 950 macro. So as you guys can see, we came down, turtle soup all these, right? And then we essentially respected the same breaker of the 950 macro. And my second entry was actually this right here. We had a fair value gap that was created here. Can highlight this, boom. So once we inverted that fair value gap and then also respected my breaker once again, and as we pushed away from that, I got in while this was essentially expanding right there. This was my entry, and then my target was standard deviation 2.5 because when we pull back, I told you, once we pull back off 1.5 standard deviation, right, what is typically going to be the target once you find your entry? 2.5 standard deviation. I hope this makes sense. So later on, you can get a pullback. We played around inside of this zone, but we respected, as you guys can see here, that same PDA of the zone again. And later in the afternoon, we eventually deliver to standard deviation 4. And as you guys can see here, standard deviation 4, if I add even maybe standard deviation -5, right? Standard deviation 4 right here perfectly hit. And then we hit standard deviation 5 and essentially closed there. So as you guys can see, we fully deliver to standard deviation 5 right here. Boom. So we fully deliver the standard deviation 5. So in the PM, the 1250 macro would have delivered all the way to standard deviation 4 or 5, depending on the target, the final target. We had a nice ovation of consolidation here. You could have looked at this as well as the ovation of consolidation right here. But like I said earlier, my ovation of consolidation, what I like to typically see is relative equal highs or a pause in price expansion or movement. So a consolidation phase essentially. Right, so this looks like a consolidation phase. We have relative equal highs and some are relative equal lows, and then boom, this will be my original consolidation. And it lined up quite, not exactly, but near standard deviation 4, which I like a lot. So another level of confluence. But this will be a beautiful illustration. Now I'm going to show you guys, I'm going to draw this a bit better now so you guys can see maybe the different phase of this curve. So if I drew the curve out, this will be our buy curve right here, right? Back this way, I should say. This will be our sell curve, okay? Does not look the cleanest, but this is the most clear identification, right? So this is our sell curve, and this is our buy curve. And sometimes it's going to be like this. Sometimes it's not going to look clean. Sometimes it's not going to look clean. Sometimes people think that, oh, after hitting standard deviation 1.5, we should never come back down to this level. Who says that? It's all based on time and price, right? If time and price aligns, you need to take that, right? I don't need to look for new SMTs of the second stage distribution if we already have it formed here. Therefore, I can simply utilize the context that we are in a market maker buy model to trade new distribution phase that get formed and confirmed, and understanding the context now, knowing that because we delivered 1.5 in the reverse here, if we find a new entry, we should deliver the 2.5 next, right? And in some case, you should deliver to 4. But usually 2.5 going to hit, and then you're going to get a pullback again. And the next delivery, guess what? Should get you where? To 4. So using that logic, if I had gotten here at 1050 macro, because this also deliver a nice formation here, a nice bullish breaker here of the 1050 macro, you could essentially hypothetically held this trade as well to all the way standard deviation 4, all the way up here. And then see how you would trade the first stage distribution of small money reversal here, second stage, and then final stage distribution, all the way to standard deviation back to 4, which will be near the original consolidation. So essentially right there. So SMR, first target, 1.5, hit first target, we reverse, next target, 2.5, reverse, tag into a PD array, created a confirmation, next target, standard deviation 4. If it lines up with the original consolidation, you can target original consolidation, or the level of liquidity that's accumulation target that's aligned with that. Boom. That's how you trade that, right? That's one of the ways to trading it. There are a multitude of ways to trading it, and I would try to create trade breakdown example to go over and show you guys how to utilize this. But I leave on the 1 minute, or I trade primarily on the 1 minute. That's where most of my entry are going to be located usually. But I do hope this makes sense, and you have a framework and you understand a little bit better how to utilize market making your trading and how to trade them, because all of this is simply a framework that you ought to understand. So when you look at the market, you have a better context, understanding of what you're trading, where you are in terms of where price is delivering and where it is going. Because I'm going to give you an example why framework is crucial. If you come into the day and then you're looking at trading the 10 a.m. symbol, because I know a lot of ICT people, this is the mistake that I've seen them do a lot. And I used to do the exact same mistake. If I came here today and I'm looking at trading the 10 a.m. silver bullet, right? For example, I'm looking and I'm literally don't even know what happened between 8:10 and 9:50. You guys that are looking at this, you guys know, we know what happened between 8:10 and 9:50, right? We know we had an SMR here, right? We know we had a first stage of distribution here or small mini reversal of the zone. But most trader that trade ICT, they'll go on YouTube and watch a video that talk about 10 a.m. silver bullet, and then they'll come and try to trade the 10 a.m. silver bullet, right? And once they try to trade that 10 a.m. silver, what they typically do? Oh, let me look for a level of liquidity that get taken out and trade the reversal of that, right? So they'll look maybe for this relative equal high to get taken out and trade back down here, right? And they may cash that win, or they may trade maybe a level of liquidity that get taken out below this level and trade upward, right? Some people may hold thinking that it may go lower, and some people may hold thinking it may go higher at that time, and then they get chopped around. And then look at this. They'll say, oh, price is simply choppy. It's not giving me any direction. Or if they get lucky, they may win, but they may not really understand why they're winning. Because they're lacking context, they're lacking framework, because you're looking at one window of delivery. You're looking at one specific phase that's happening within a 40-minute window with no understanding of what have happened 2-3 hours prior to coming into that specific windows. So that's having framework, that's having context. You always need to be aware of what the last windows of delivery has delivered, what price is seeking to distribute, where price is seeking to distribute. Was there any sort of manipulation? Do we have any sort of market maker model in play? Was there any sell curve that was created? Was there any buy curve that was created, maybe from a sell or on buy model, right? You need to understand those things. It's crucial, right? Once you start piecing those things together consistently, I promise you, your trade will start having a lot more context. Your application and your analysis will start having a lot more context. That is all for today for this masterclass. If you guys found tremendous value in what we shared today, if you feel like this opened your eyes to in regards to a lot of the things that maybe you've seen before, but now it's starting to make sense, please let me know in the comment section down below. Also, please share this with as many people that you feel like will gain value from listening to this and learning from this. I put a lot of work and thought into every single thing that I essentially shared today. If I'm able to help someone out there that's maybe struggling with piecing certain things together, utilizing this framework, understanding to be able to get to the next level, that will be my pride and joy. The only thing I ask is that you guys share, like, and subscribe, and keep giving me a recommendation for what type of masterclass would you like me to present on the next few videos. I'm open to suggestion. Actually, this masterclass on market maker was actually suggested. I can do one specifically on standard deviation. I can do one specifically on SMTs and go over a few examples and how to utilize them. Do let me know. I'll go ahead and make a specific video on that and on a masterclass. I'm losing my voice. I'm coming close to the end of the video. I'm glad if you guys stuck it to this stage. I really appreciate you. I hope this was insightful. And until next time, guys, stay in profit.